Imagine checking your company's bank account on like the very last day of the quarter. And, your sales team just closed record-breaking deals. Your manufacturing floor is operating at peak efficiency. By literally every operational metric, you have absolutely crushed it.
Best quarter ever, right?
Exactly. But then you look at the bottom line and a sudden 2% shift in the Japanese yen or maybe an unexpected 50 basis point hike in global interest rates, it just wiped out your entire profit margin for the whole year.
Oh, yeah. Poof. Just gone.
Completely gone. Your core business is thriving, but your balance sheet looks like an absolute disaster zone. And so today we are looking at the financial dark arts companies use to prevent exactly that scenario from destroying their business. And more importantly, we're looking at why getting the paperwork wrong on those defensive maneuvers can trigger a catastrophic stock crash.
Yeah. I mean, it happens far more often than investors realize. We are talking about the underlying plumbing of global finance here. And when that plumbing works, nobody notices. But when it breaks, or when an auditor realizes a company misclassified a massive derivative contract, the resulting earnings shock can take billions off a company's market cap overnight.
It's terrifying, which means we all really need to understand how this plumbing actually works. So I want to welcome you to a brand new episode on the GAAP Advisors Ind AS Clinic podcast. Our mission for this deep dive is to demystify one of the most technical, fiercely debated, and critically important areas of financial reporting.
Yep, accounting.
Right, hedge accounting. We're going to definitively break down the friction points between cash flow hedges and fair value hedges.
And we're going to look at the severe consequences of mixing them up, because this isn't just about moving numbers between columns, right? It is about reflecting the actual economic reality of risk.
Yeah, but before we pull apart the mechanics, I feel like I need to address the elephant in the room here. If you are an everyday person, right, just investing your hard-earned money in shares of a listed company, why on earth do you need to understand dense accounting standards? I mean, shouldn't you just pull up the quarterly P&L, check the earnings per share, and just call it a day?
Well, that is a remarkably dangerous game to play as an investor. Just think about how algorithmic trading works today. Wall Street, Dalal Street, they run on algorithms that scan the profit and loss statement, the P&L, and they trade in milliseconds based on earnings per share misses.
Right.
But the P&L is just a filtered lens. Accounting standards dictate how that lens is ground and polished. If you don't understand how a company is permitted to hide or, expose its hedging risks under these standards, you are completely blind to the hidden exposures lurking on their balance sheet.
So they could look great on paper today.
Exactly. A company might show a beautiful, steadily climbing profit today, but if their hedges are misaligned, a sudden shift in the macroeconomic environment could force them to dump massive, previously hidden losses straight into the P&L tomorrow.
Wow.
So understanding these standards is really the only way you genuinely protect your hard-earned capital. You have to know what standard setters allow companies to keep off the current scoreboard.
You cannot just read the scoreboard. You have to know the actual rules of the game being played, which I guess brings us to the field manual we are using today. The source material for this deep dive is incredibly practical. It is an actual real-world query pulled directly from the massive issue repository on GASadvisors.com.
Oh, yeah. For professionals in the trenches, that repository is an indispensable tool.
It is genuinely staggering in its scope. The repository on GAPAdvisors.com currently hosts over 4,500 specific complex issues and their detailed responses on Ind AS and Indian GAAP. And any person listening right now can register for free on the site and submit their own issues on Ind AS and Indian GAAP.
And you get a real answer back.
Right. You get a highly detailed, legally rigorous response delivered directly to the inbox of the email you registered with.
Think about what that means for an auditor, though. When you are auditing a massive multinational corporation and you encounter some weird bespoke derivative contract, you cannot just guess how to account for it.
No, absolutely not.
You need a rigorous, documented audit trail showing exactly how you address the application of Ind AS. So having access to a verified repository of 4,500 resolved issues provides that critical layer of professional defense.
Yeah, that's huge. And our specific case study today was actually featured in the 208th edition of the GAAP Advisors Task Weekly newsletter. That newsletter is authored by C.A. Manish C. Iyer, the director of GAAP Advisors, and it is published directly on LinkedIn. They have published over 230 editions to date.
It's a goldmine of information.
It really is. So if you are registered on LinkedIn, go subscribe to the newsletter for free. It is a constant feed of high-level professional development. Also, just to throw this out there early, if you're wrestling with this stuff at work, you can book a one-on-one consultation on your issues on Ind AS and IFRS with the author directly from his page on topmate.io.
Highly recommend that. Now, before we tear into the user's query, we really must establish our environmental parameters. We need to define the sandbox we are playing in today.
Right. Lay the ground rules.
First, the response to this query is given strictly under the Ind AS framework. However, standard setters have pretty much aligned globally on this specific issue. Because there is absolutely no difference between Ind AS and IFRS for the topic of hedge accounting being discussed today, this entire deep dive can be directly applied by all entities following the IFRS framework globally.
Okay, that is a huge relief. No regional translation required.
Exactly. Second, let's lock down the variables. For every example we use today, assume the functional and presentation currency of our hypothetical company is the Indian rupee INR. Consequently, any currency other than the functional currency is automatically classified as a foreign currency.
Makes sense.
Finally, we are operating on a standard reporting period, so that's beginning on the 1st of April and ending on the 31st of March.
Okay, so INR is home base, April to March is our timeline. And one mandatory disclaimer before we proceed into the technical weeds here. The views expressed herein are the personal views of the author of the source material and are not binding on you, the audience. We strongly request that you seek the help of a qualified expert before taking any action or, refraining from any action based on the views discussed in this deep dive.
Right. Always get an expert. So with the guardrails up, let's look at the actual query submitted to the repository. The professional who submitted this is already operating at a pretty high level. They understand the fundamental bookkeeping rule of hedge accounting.
Yeah, let me map out what the user already knows, because I think it sets up the whole friction point for this deep dive. The user understands that when you create a hedge, you basically split the accounting into two buckets based on how well the hedge actually works in reality.
The effective and ineffective portions.
Right. The gain or loss on the effective portion of the hedge is taken to FVOCI. But the gain or loss on the ineffective portion is immediately dumped into the profit and loss account, the P&L. So their question isn't about the bookkeeping part. Their hurdle is knowing when to use a cash flow hedge versus a fair value hedge, and fundamentally what the actual difference is between the hedged item and the hedging instrument.
And to answer that, we really have to look at the psychological intent behind those two buckets. Let's look at that acronym first, FVOCI. Fair value through other comprehensive income. What is that, really?
Let me take a stab at this. If the P&L is the company's current operational scoreboard, like the thing that drives the stock price today, then FVOCI is essentially a waiting room on the balance sheet. It's like a holding pen in the equity section.
That is the perfect way to visualize it. Standard setters created that waiting room for a very specific reason. If you enter into a derivative contract to protect yourself from a future risk, the value of that derivative is going to fluctuate wildly every single day based on market conditions.
Yeah, it would be chaotic.
Right. If all those wild swings hit your P&L today, your earnings would look like an electrocardiogram during a heart attack.
Yep.
Investors would panic. So the standard setters say, hey, if you can prove mathematically that this derivative is a highly effective shield against a specific risk, we will let you park the temporary unrealized gains and losses in the FVOCI waiting room. We will let you keep that noise off the main scoreboard.
Oh, I see. But the moment that shield cracks, the moment the hedge is deemed ineffective,
the standard setters revoke the privilege immediately. Any mismatch, any inefficiency where the derivative doesn't perfectly offset the risk gets dragged right out of the waiting room and slapped directly onto the P&L. You must show the market your mistakes right away.
Okay, well, that clarifies the stakes entirely. If you classify the hedge wrong, or if you fail to prove its effectiveness, you lose the waiting room. Your earnings take a massive hit. So let's define the fundamental components that make up this relationship. The user asked for the difference between a hedged item and a hedging instrument.
We can break this down by looking at the source of the anxiety versus the cure for the anxiety. The hedged item is the source of the pain. It is the underlying asset, the liability, or the highly probable firm commitment that inherently exposes the company to financial danger.
Like what, specifically?
It's the floating rate loan dragging down your cash, or the massive inventory of copper you hold that is dropping in value on the global market. It exists in the normal course of your business.
So the source material actually suggests using a pretty basic analogy here. If you own a beach house in a known hurricane zone, the house itself is the hedged item. It's your asset. But just by existing on that beach, it carries this massive inherent risk of being wiped out by weather.
Yes, exactly. The house is the hedged item, but you don't just sit on the porch waiting for the storm, right?
Yeah.
You actively go out and procure a defense mechanism. You buy a hurricane insurance policy.
Right.
In corporate finance, that insurance policy is your hedging instrument. It is a specific, deliberate financial tool, almost always a derivative, like an interest rate swap, a forward contract, or a currency option that you acquire for the sole purpose of neutralizing the danger originating from the hedged item.
And the crucial part of that analogy, I think, is that the insurance policy, the instrument, only exists because of the house, the item. Like, if you sell the house, you cancel the policy. They are legally distinct contracts, but they are entirely economically linked.
And proving that economic link is what keeps you in the FVOCI waiting room. If your house takes 1 million rupees of damage and your insurance policy pays out exactly 1 million rupees, the hedge is 100% effective. The loss and the gain cancel each other out perfectly.
Which is the dream scenario.
Right. But if the policy has a weird loophole and only pays out 800,000 rupees, you have a 200,000 rupee mismatch. That is the ineffectiveness that immediately crashes into your P&L.
Okay, that makes perfect sense. And that brings us right to the core of the user's dilemma. If I have an exposure, how do I know whether standard setters require me to classify this defensive maneuver as a fair value hedge or a cash flow hedge? Let's tackle the fair value hedge first. What is the actual rule book definition we are dealing with here?
Well, the source material pulls the definitive text from paragraph 6.5.2 of Ind AS 109 Financial Instruments. It defines a fair value hedge as, quote, a hedge of the exposure of changes in fair value of a recognized asset or liability, or an unrecognized firm commitment, or a component of any such item that is attributable to a particular risk and could affect profit or loss, unquote.
I am going to be completely honest here. Exposure of changes in fair value of a recognized asset sounds exactly like a lawyer trying to avoid giving a straight answer. Let's ground this in reality.
Yeah, let's strip away the jargon. A fair value hedge is fundamentally about protecting your opportunity cost. You are trying to protect the theoretical market value of something you already have locked in on your balance sheet.
Okay.
You aren't losing sleep over the actual cash leaving your bank account today because your cash flows are stable. You are losing sleep because the broader market has shifted, and the static item on your balance sheet is suddenly looking like a terrible deal compared to what is available outside your window.
Let me try to map this out using the classic example from the source text, because initially it feels completely backward to me. The text states that the quintessential example of a fair value hedge is a receive fixed, pay variable interest rate swap.
Yes, that's the classic textbook case.
Right. Now let's step into the shoes of a CFO for a second. The text says, my hedged item is a liability with a fixed interest rate. Let's say I borrowed 50 million rupees, and I brilliantly locked in a fixed interest rate of 8% for the next 10 years. As a CFO, I'm thrilled, right? I have total certainty. I know my interest payment is exactly 4 million rupees a year. Why on earth would I intentionally introduce a derivative swap that forces me to pay a variable rate? Doesn't that just invite chaos?
It looks like chaos until you look at the broader macroeconomic environment. Let's follow your scenario. You locked in that 8% fixed rate. Your cash flows are perfectly certain. 4 million rupees out the door every single year. But 6 months later, a global recession hits.
Okay.
The central bank aggressively slashes interest rates to stimulate the economy. The current market rate for corporate debt plummets from 8% down to 4%.
So my competitor, who built a factory right across the street from mine, goes to the bank today and borrows 50 million rupees, but they only have to pay 4%. Their interest burden is only 2 million rupees a year.
Exactly. And suddenly, your certainty is killing your competitive advantage. You are bleeding 2 million rupees a year in opportunity cost. Your competitor is using that extra 2 million to lower their prices and steal your market share.
That's a nightmare.
Because you are tied to a higher than market interest rate, the fair value of your debt has changed radically against you. If you tried to sell your company tomorrow, a buyer would penalize your valuation because they are inheriting a toxic, overpriced loan. You are legally trapped overpaying relative to the market.
Okay, the pain point is super clear now. The risk isn't that my cash outflows will suddenly spike. I mean, they won't. They're fixed. The risk is that my cash outflows are stubbornly frozen while the rest of the world gets a massive discount. I'm suffering a fair value loss. So how does the receive fixed pay variable swap act as the hedging instrument to actually fix this? Let's trace the actual journal entries and cash flows.
You need a structural overlay to essentially mutate your debt. You keep your original loan with bank. You still owe them the 8% fixed. But you go to an investment bank and enter into an interest rate swap.
Okay, what are the terms?
The terms of the swap are simple. The investment bank agrees to pay you a fixed 8% on a 50 million rupee notional amount. In exchange, you agree to pay the investment bank a variable rate pegged to the current market benchmark.
All right, let's run the math on a single payment cycle. I have to physically wire 4 million rupees to my original lending bank to satisfy my fixed 8% loan.
Right.
But on that exact same day, the investment bank wires me 4 million rupees to satisfy the received fixed leg of the swap.
Look at the net result there. The 4 million you receive perfectly offsets the 4 million you owe. The fixed legs of the two separate contracts just annihilate each other. So what cash flow is actually leaving your corporate treasury?
The only thing left is the pay variable leg of the swap that I owe the investment bank. I have effectively transformed my fixed rate debt into variable rate debt.
Exactly. Now, because market rates dropped to 4%, the variable leg of your swap requires you to pay the investment bank 4%. You get to ride the market curve all the way down. You are now paying the same effective rate as your competitor across the street.
Wow.
By entering the swap, you have neutralized the opportunity cost. You have protected the fair value of your liability position relative to the current market.
That is just a brilliant piece of financial engineering. Think of a fair value hedge, like buying a fixed price fuel contract for your massive trucking fleet at 100 rupees a liter. You have certainty.
Yeah.
But a week later, global oil crashes and the pump price is 50 rupees a liter. You feel like an absolute fool. Your competitor is shipping freight for half the cost. The swap is the equivalent of finding an independent trucker and making a side bet. Hey, I will pay whatever the pump price is, and you just cover my 100 rupee fixed contract. You regain market parity.
That is a highly accurate analogy. And under Ind AS 109, the accounting perfectly reflects that logic. Because this is a fair value hedge, the carrying amount of your original loan on the balance sheet is actually adjusted for the change in fair value attributable to the hedged risk, and the derivative is measured at fair value.
So they both hit the P&L.
Yes, both the gain and the loss flow through the P&L, naturally offsetting each other in the exact same period, which minimizes the net earnings shock.
Okay, I have my head fully wrapped around the fair value hedge now. We're protecting opportunity cost. Let's flip the paradigm and look at a cash flow hedge. Let's start with the official text from Ind AS 109, paragraph 6.5.2 again.
The standard defines a cash flow hedge as, quote, a hedge of the exposure to variability in cash flows that is attributable to a particular risk associated with all, or a component of any such item that is attributable to a particular risk and could affect profit or loss, unquote.
All right. If the fair value hedge was about protecting our theoretical market standing and opportunity cost, the source material implies the cash flow hedge is about pure, visceral survival. We are protecting against the terrifying unpredictability of actual cash being drained from our bank accounts.
That really is the dividing line. A fair value hedge protects your opportunity cost. A cash flow hedge protects your survival. You are no longer worried about what an asset would theoretically sell for. You are staring at next month's payroll and wondering if you will have the liquidity to actually meet it.
Let's use the mirror image example from the text. The classic structure here is a receive variable, pay fixed interest rate swap.
Let's walk through the nightmare scenario that necessitates this. What is our hedged item this time?
Our hedged item is a financial liability carrying a variable interest rate. Let's revisit our company. You need 50 million rupees to build a new warehouse. But this time, you don't lock in a fixed rate. You take out a loan linked to a floating benchmark rate. And currently, the market is incredibly cheap. You're only paying 3%. Hey, 3% is fantastic. My cash outflow is incredibly low. I'm paying just 1.5 million rupees a year in interest. My working capital is totally flush.
But the sword of Damocles is hanging over your Treasury Department. You have zero certainty. What if a geopolitical crisis erupts? Inflation spikes globally. To combat the inflation, the central bank panics and hikes interest rates aggressively, month after month.
That is the survival threat right there. If the market rate rockets from 3% to 12%, the actual cash leaving my operating account quadruples. Suddenly owe 6 million rupees a year in interest. That kind of unbudgeted cash drain doesn't just hurt my margins, it could trigger debt covenants, force massive layoffs, or even push the company into insolvency.
Exactly.
The fair value of the debt isn't the problem here, because a floating rate loan is always mathematically at fair value.
Right.
The problem is I am bleeding actual cash.
And to stop that bleeding, you must acquire a hedging instrument. You go back to the investment bank and execute a swap contract to receive variable and pay fixed. You want to synthesize the certainty you originally turned down.
Okay, let's trace the plumbing on this one. I am terrified of my variable rate spiking to 12%. So I enter a swap where I agree to pay the investment bank a fixed rate. Let's say we lock in at 5% as a fair premium for the insurance. In exchange, the investment bank agrees to pay me whatever the variable market rate is.
Right. Then the geopolitical crisis hits. Inflation surges. Your underlying loan resets to the punitive 12% rate. The lending bank automatically deducts 6 million rupees from your account. It looks like an absolute disaster. But wait, look at your swap contract. Because the market benchmark is now 12%, the investment bank is legally obligated to pay you 12% on the notional 50 million.
The relief is immediate. The investment bank wires me 6 million rupees. That variable cash inflow perfectly, mathematically matches the variable cash outflow I owe the lending bank. They neutralize each other entirely.
And when the dust settles, what is the only cash flow obligation remaining?
The fixed 5% payment I agreed to pay the investment bank on the swap. No matter what the global economy does, whether rates go to 2% or 20%, the variable leg of the swap will always catch and neutralize the variable leg of the loan. I have successfully synthesized a fixed-rate loan at 5%. I have achieved absolute cash flow certainty.
And because your primary objective was mitigating cash flow variability, standard setters dictate that you use cash flow hedge accounting. This brings us right back to our FVOCI waiting room.
Right.
If you can rigorously document that the variable swap receipts perfectly align with your variable loan payments, the standard setters allow you to take the mark-to-market fluctuations of that swap, which, could be massive during a geopolitical crisis, and park them safely in FVOCI. They don't hit your P&L until the actual interest payments occur, which perfectly matches the expense recognition.
The logic is just airtight. Fair value hedge. I have fixed certainty, but I want to participate in market movements so I don't lose my competitive edge, so I swap to variable. Cash flow hedge. I am exposed to terrifying variable market movements, and I want fixed certainty to protect my liquidity, so I swap to fixed.
It's elegant. But standard setters never let things remain that simple. They introduce a massive curveball when we cross borders.
Oh boy. Which brings us to the final and perhaps most nuanced paragraph of the source material. Real-world applications get messy the second we introduce foreign currency risk. Just to reinforce our environmental parameters here, since our functional currency is the Indian rupee, any transaction denominated in US dollars, euros, yen, or pounds is carrying foreign currency risk.
And foreign currency risk is the bane of literally any global supply chain. The exchange rate between the rupee and the dollar doesn't just fluctuate daily, it fluctuates by the second. If you import raw materials or export finished goods, FX risk is a constant, unavoidable friction.
The source text highlights a very peculiar rule when dealing with currency risk, though. It states that for a hedge of currency risk, an entity actually has a choice. Management may elect to account for it as either a fair value hedge or a cash flow hedge. It depends entirely on exactly how they structure it and what their internal risk management objective is.
That's right. It's a choice.
Let me test that logic, because giving management a choice usually leads to opportunistic accounting, right? Can a CFO just sit down at the end of the quarter, realize that a P&L hit is going to decimate their annual bonus, and arbitrarily say, you know what, let's just designate this currency hedge as a fair value hedge instead to make the math look better?
No, absolutely not. Standard setters are acutely aware of earnings management, which is why the documentation requirements are so draconian. You must designate and document the hedge relationship, your objective, and your strategy at the inception of the transaction. You cannot retroactively change your mind just because the math doesn't favor you later.
Okay, good. But why does the choice exist in the first place? Why isn't it binary like the interest rate examples we just went through?
Because a foreign currency exposure fundamentally contaminates both fair value and cash flows simultaneously. It's a dual threat. Let's say you take delivery of equipment from Germany today, and you have a recognized account payable of 1 million euros due in 90 days.
Okay, so the liability is recognized on my balance sheet today.
And every single day over those 90 days, as the rupee-euro exchange rate moves, the equivalent fair value of that recognized liability changes. Your balance sheet is expanding and contracting based purely on FX rates. That is a fair value risk.
Sure.
But simultaneously, on day 90, when you actually have to convert rupees to buy those euros to settle the bill, the actual cash flow required will be highly variable. That's a cash flow risk. Because the exposure attacks both vectors, Ind AS allows you to look at your specific risk management mandate and declare whether you are primarily trying to protect the balance sheet valuation or primarily trying to lock in the final cash outflow.
That is genuinely fascinating. The accounting standard flexes to accommodate the economic intent of the business, provided they document it up front. But the source text doesn't stop there. It drops a hammer. It outlines a strict boundary where that choice is violently revoked.
The highly probable forecast transaction.
Yes. The text states, however, if the hedged item is a highly probable forecast transaction, the entity shall account for the hedge only as a cash flow hedge. Shall. Only. That leaves absolutely zero room for interpretation.
It is a hard stop. If it is a forecast transaction, the fair value hedge option is removed from the table entirely.
Why is this the absolute unbreakable rule? What makes a highly probable forecast transaction so unique that it overrides the dual nature of currency risk we just discussed?
We can solve this by going back to the foundational definitions we established a little while ago. Think about the mechanical reality of a forecast transaction. Let's say your manufacturing process relies on specialized microchips from Taiwan. It's currently July. You know with absolute certainty that in November, you are going to need to purchase $2 million worth of these chips to meet your holiday production quotas.
Okay, so it is highly probable. It is fully baked into my business plan.
But it is purely a plan. It is a future event. Have you taken delivery of the chips today? No. Do you have a binding, irrevocable invoice from the supplier today? No. Therefore, under accounting rules, do you have a recognized asset or a recognized liability on your balance sheet today?
No, I don't. There's nothing to record. The transaction hasn't legally materialized yet.
And here is the fatal logical flaw in trying to use a fair value hedge. If there is no recognized asset and no recognized liability, there is fundamentally no current fair value on your balance sheet to protect. You physically cannot hedge the changing value of a phantom asset that does not exist in your ledger yet.
Oh, wow. That is the light bulb moment right there. You cannot protect the fair value of zero.
Exactly. The only tangible financial exposure you face regarding that November purchase is the anxiety over how many rupees you will ultimately have to drain from your bank account to buy those $2 million when the time comes. Your risk is entirely, 100%, isolated to the variability of future cash flows.
Because the risk is exclusively a cash flow risk, mathematically and logically. The derivative you buy to protect it must be classified strictly as a cash flow hedge. I love it. It is immensely satisfying when dense accounting rules aren't just arbitrary red tape, but actually align perfectly with the physical reality of the transaction.
It's rare, but it happens.
We have journeys from the basic definitions of risk, navigated the absolute alchemy of interest rate swaps, and arrived at the strict, undeniable logic governing future currency transactions.
And this brings us full circle to why getting this wrong is catastrophic. A cash flow hedge relies on the premise that a future transaction is actually going to happen, allowing you to hide the derivative's volatility in the FVOCI waiting room. But what happens if the future doesn't play out the way you forecasted?
Oof. Which serves as the perfect final thought for you, the listener, to ponder as we wrap up this deep dive. Consider the monumental pressure on accountants, auditors, and CFOs to accurately identify what constitutes highly probable. They are essentially being asked to act as corporate fortune tellers.
And they are making these prophecies in a profoundly unstable world.
Exactly. In a global market where shipping lanes are blocked overnight, where tariffs are implemented with a single tweet, and where suppliers go bankrupt without warning, predicting what is highly probable to happen 6 months from now is an insane high-wire act. Let's say a finance team declares an inventory purchase is highly probable. They enter a massive currency derivative to hedge the cash flow, and they park millions of rupees of unrealized losses safely in FVOCI, shielding the P&L.
But then the supplier's factory burns down, or a pandemic halts global shipping. The transaction is no longer highly probable. In fact, it's just canceled.
The foundation of the hedge completely unravels.
Yeah.
Because the underlying transaction will never happen, the standard setters immediately revoke your access to the FVOCI waiting room. All of that hidden volatility, all those accumulated losses on the derivative that were quietly tucked away in the equity section, must be immediately reclassified and violently dumped straight into the current quarter's profit and loss statement.
It creates a massive, entirely unexpected earnings shock. It is the kind of sudden P&L hemorrhage that causes analysts to downgrade the stock and algorithms to initiate massive sell-offs. It highlights why rigorous documentation, robust internal risk models, and expert guidance are not bureaucratic overhead. They are the critical defense systems preventing financial chaos.
Truly. And speaking of expert guidance, if you or your firm are staring down a complicated derivative contract, Or if your audit team is debating whether a transaction is genuinely highly probable, you do not have to navigate that minefield alone. You can book a one-on-one consultation on your specific Ind AS and IFRS issues directly with the author of today's source material, CA Manish C. Iyer. You can secure time with him directly from his professional page on topmate.io. It is an incredible opportunity to get bespoke, expert insight to bulletproof your financial reporting.
Having an authoritative sounding board for these nuanced interpretations is literally the difference between passing an audit smoothly and facing a public restatement.
We want to profoundly thank you, the audience, for dedicating your time to this deep dive today. We know hedge accounting is an incredibly dense topic, but your willingness to look under the hood of the financial world makes you a sharper professional and a significantly safer investor. We formally request that you follow or subscribe to the GAAP Advisors Ind AS Clinic podcasts on Spotify, Amazon Music, or YouTube, whichever platform you prefer to listen to GAAP Advisors Ind AS Clinic podcasts on. Subscribing ensures you never miss a deep dive into the mechanics of the market.
And please do not keep this knowledge siloed.
Yes, we urgently request that you share this deep dive among your contacts, your colleagues, and your audit and finance teams. And especially, please share this with students pursuing their CA course. Spreading this granular knowledge on the application of Indian accounting standards elevates the rigor, transparency, and safety of the entire financial community. The better we all understand the plumbing, the stronger the foundation of the market becomes. So until next time, keep questioning the numbers, keep digging into the footnotes, and remember, just because you bought the hurricane insurance doesn't mean you understand how the payout is going to hit your P&L. Catch you on the next deep dive.